Hey everyone, this is Libertarian Black Man. Real libertarians oppose fractional reserve banking. This is an issue that unfortunately does divide the libertarian community. Some of us support this, others oppose it. I'm a staunch opponent of this, as is Ron Paul and many other outstanding libertarians. But I'm going to show you why this is a terrible system and no libertarian should support it. Defining what fractional reserve banking is basically a system of banking in which a fraction of the bank deposits are backed by actual cash on hand for withdrawal. This is done to expand the economy by making more money available, by freeing up capital for loans. And the problem is that when you have financial crises, banks run out of money so quickly because too many people attempt to withdraw money under this system. This is one thing that led to the Great Depression. Another way of looking at this system is that if you deposit $100 into your savings account, the bank is legally allowed to take a majority of that money out. In this case, $95 of that $100 can be taken out for lending. In this situation, the bank has taken money out of your account without your direct authorization. We know this as theft. Anytime somebody takes money from you without your permission, they are committing the act of theft. Proponents of fractional reserve banking like to say that this is not theft because the bank put it in the contract that you signed when you opened your savings account that they have the right to take money out of your account for lending, and therefore they're informing you, and you are signing that contract giving permission to the bank to do this. The problem with this argument is that the bank is trying to have it both ways. They're trying to say that they have the right to access your money, but that you also have the right to access your money. You just can't have it both ways. Either one side has the right to it or the other side does. And in a savings account, people put their money there because they don't want it to be spent. That's why it's called a savings account. If they wanted it to be spent, they would put it in another account for that purpose. But a savings account is for money you do not want spent. The bank is trying to claim that we have the right to spend it even though it is not a lending account. That's why savings accounts are not called lending accounts, because they're for people who want their money parked in a location where it will stay until they decide to do something else with it. So when the bank goes in to your account, even though they say in the contract they have the right, it's an oxymoronic contract, basically saying that you and the bank both have claims on that money, and that's an impossible situation. So it is theft when the bank takes your money without your direct authorization. When the bank takes $95 out of your $100 deposit, your account should say $5. $100 minus $95 is $5. That's pretty easy math. But in the world of fractional reserve banking, $100 minus $95 is $100. That clearly doesn't add up, but that is how accounting is done in the fractional reserve system. Your bank is allowed to state that your account has $100 in it when it only has $5. That is known as fraud. It is telling you you have far more money in your account than you actually have. Clear-cut case of fraud, and if you were to do this outside the banking system, you would go to jail because you would be convicted of fraud, of lying to your investors that you have more of their assets than you actually have. The reason the bank is able to state you have more money than you actually have is because they put the money back into your account, but they do it fraudulently. So in this case, the bank puts $95 back into your $100 account so that the balance reflects $100 instead of $5. And they do this fraudulently by creating the money out of thin air, by typing in numbers into your account. Banks do not print money. They don't have a printing press. At least in this country, that's the way it works. It's only the government that has a printing press. So banks are not creating physical coins and paper bills to put in your account. They're just typing in numbers, which means the money isn't real. It's fake. It's phony. It's just numbers in a computer. And the money physically doesn't exist. But it will exist on paper. And as a result, your account will reflect the fact that they created phony money that is not backed by physical cash. So the bank, in doing this, actually added $95 to the money supply from your $100 deposit by taking it out of your account, lending it to someone else who put it in their account for spending, and then typing in another $95 to put in your account. Now you've got a total of $195 out there. 100 in your account, 95 in a different account that they loan the money to. This is where you get inflation, because the money that the bank lended to someone else should have stayed in your account. The fact that it came out of your account and went to somebody else for their spending purposes contributed to the inflation. The fact that they typed in that money back into your account and says that you now have the right to withdraw that also will contribute to the inflation. So physically, the bank does not have the money, and the way that it has to get it is by raising interest rates and by borrowing from other institutions. Fractional reserve banks are insolvent by design because they always declare more reserves on paper than what physically exists. Again, this is the essence of fraud. If you are saying you've got $10 million when you only have $1 million, that is a fraudulent statement. And if you were to add up all the balances of all the savings and checking accounts at banks, you're going to get an amount of money that is far larger than what you would get if you would open all the vaults of all those banks and count the coins and paper bills. So with this system, we maximize the risk of deposit losses and bank runs because most of the money that is stated to be at the bank doesn't exist. And if too many depositors try to withdraw, then you're going to shut the bank down and cause those who haven't gotten to the bank to make a withdrawal to lose all their money. This system generates more severe economic boom and bust cycles because the inflation creates an economic boom. Prices go up, investment goes up, and once prices get too high, then consumer spending will drop, and you'll have boom turn into bust. You'll have a recession, you'll have higher unemployment, you'll have a falling stock market, you'll have a lot of things that took everybody by surprise. And that is what the business cycle tends to do. There's an upswing and a downswing, mainly due to the fact of the flow of money, which creates signals throughout the economy either to invest or divest. But ultimately you have a more severe fluctuation of economic activity. This system also incentivizes mergers that make banks too big to fail. When banks have fractional reserves, they're constantly worried that they may exhaust those reserves in some kind of a panic situation. So what they do is they align themselves with other banks so that they can access their capital more quickly. And this can happen many times to the point where a bank that used to be a small bank now ends up owning more than half the assets in the economy. That would be a too big to fail bank. A bank that owns or that safeguards more than half of the assets in the economy can take an entire economy down if it fails. And when that happens, you have the worst of all outcomes, which is that demand is being generated for government and central bank backstopping of deposits. The regulations that we have today are the result of financial crises that occurred in the 19th and early 20th century, which led to the formation of the Federal Reserve and led to deposit insurance and other regulations on the banking system. So libertarians who are against big government should really understand that fractional reserve banking takes us down the path to big government, because it puts more risk in the financial system, and the financial system can take down the entire economy, as we saw 10 years ago with the Great Recession. Ultimately, government got bigger, the banking sector got bigger, the Federal Reserve, our central bank, got more involved in our economy, and all because we have a system where we allow banks to declare funds that they do not exist. One of the libertarians who thinks it's a good idea to have fractional reserve banking is John Tamny, and he wrote this article a few years ago titled Ron Paul, Fractional Reserve Banking and the Money Multiplier Myth. In this article, he's critical of Ron Paul because Ron Paul opposes fractional reserve banking like all libertarians should. John Tamny says if fractional reserve banking did not exist, wise minds would soon invent it, given the desire among most individuals to be compensated for their savings. In other words, you can't earn interest on your money without fractional reserve banking. This is wrong, and I'll show you why. He also says it's certainly true that banks could maintain 100% reserves, but if they did so, they wouldn't be banks. They would be warehouses that charge depositors fees to deposit their money with them, and says that the money saved by depositors would decline day by day, essentially compound interest in the reverse. Again, this is wrong. Let me show you why. Banks can make the money available for lending without fractional reserves. All they have to do is sell something called a certificate of deposit, a CD. Banks can sell CDs to depositors who buy them, and the purchase would allow the bank to have the money to lend to someone else. Depositors would understand that they cannot access this money until the loan is fully paid, but they can earn interest monthly, quarterly, or semi-annually on this money that has been loaned out. And banks would likely receive a cut of the interest because they have to make money no matter what they're doing, whether they're charging fees on deposits or taking a cut of the interest from the loan that's being paid back. They have to make money some way in order to be able to provide services. The Mises Institute called John Tamny out on his views, where he is saying that fractional reserve banking is a good idea, and pointed out that Tamny actually advocates a 0% reserve requirement, which legally allows banks to inflate without any mathematical upper limit on money supply growth, which is nuts. That means that the bank is allowed to take every dollar and cent out of a person's account and put it at risk. Of course, Tamny concludes his article with kind of an arrogant tone, saying that as for fractional reserve banking, its detractors need to be serious. Businesses are in the business of profits, and the path to banking profits is to lend out as much money as prudently as possible, saying that basically myself and other libertarians are highly confused detractors, and we don't really hate fractional reserve banking. We just don't like bailouts. Here's the problem. If there's anybody highly confused here, it's Mr. Tamny. We do hate fractional reserve banking because it commits the crime of theft and fraud and inflation all in one of the highest magnitude, and it must be abolished. If we oppose big government, we should oppose this system, because this system just injects the kind of risk into our economy that will pave the way for people to embrace big government as a means of trying to fix this system. And you have a lot of money declared in existence that doesn't actually exist. Like I said before, all of the bank statements are fraudulent. Whatever it says, just imagine that only 10% of what is stated on your balance sheet actually exists. And you get a lot of distortions in the economy when you have this kind of money not being properly declared in existence. Thanks for watching. Please subscribe to the YouTube channel Libertarian Black Man. Follow the Twitter page Libertarian Black Man, and we hope to see you in the next video.